The stock market in general is known for being volatile and unpredictable throughout history. But in the recent months, the volatility and unpredictability of what's going to happen next has been taken to a whole nother level. The current conditions of the stock market have been nothing short of chaotic, with wild swings in the market becoming a common occurrence, and seeing massive market cap stocks as well as ETFs swing like crazy pretty much has just become something normal that we're growing used to. One of the main drivers for the uncertainty going on in the stock market is a trickle-down effect from the rising of interest rates. In recent, we've even seen certain banks fail, and of course the fear that many could follow. And with all this uncertainty, we are now seeing different companies choosing to cut their dividends, and this could be because of a variety of reasons. And here are some of the specific reasons why we've been seeing a variety of dividend cuts as of recently. Some companies may choose to cut their dividends because of cash flow concerns. During times of market uncertainty, companies may experience a decline in revenue or increase in expenses, like interest rates increasing, which can put pressure on their cash flow. If a company is struggling to generate enough cash to fund its operations, it may need to conserve cash by cutting or suspending its dividend. Another reason companies might choose to cut their dividend is capital preservation. In uncertain times, companies want to preserve their capital in case they need it for future investment or to weather a potential downturn, like a recession or something even worse. By cutting or suspending the dividend, companies can retain more of their earnings and build up their cash reserves. Another reason could be investor sentiment. In cases like we've seen recently, companies may cut their dividends to signal to investors that they are taking the current market conditions seriously and are taking steps to protect their financial position. This can help bolster investors' confidence and prevent a further decline in a company's stock price. And this has been something interesting to see in both cases. In my past 5 or 6 years of dividend investing, I've seen it where a company chooses to cut their dividend to conserve cash and to sort of signal to investors that they're serious about their company and that they're taking the current steps to protect their financial position. But sometimes it blows up in their face. Sometimes you see companies cut or suspend their dividend in hopes that it would actually drive the stock price up, because in theory, it's making the investment even more valuable. But I've seen both cases happen. Sometimes this does drive the stock price up, and it makes the stock a safer investment. But I've also seen it happen where a dividend is cut or suspended, and the stock price plummets even further from there. Simply put, cutting dividends in market uncertainty is a difficult decision for companies to make, as it may have a negative impact on their stock price and, of course, the relationship with investors. Lots of investors like myself really rely and depend on that dividend income coming in. So I think we'd all be lying to think that some investors wouldn't be upset when dividends are cut or suspended. I wanted to go through next and actually share some of the companies that have recently cut their dividends, and hopefully neither one of us have any of these holdings in our portfolios. So as of the 14th of March, ticker symbol CVGW cut their dividend from 28 plus cents a share down to 10 cents a share. That's a minus 65.16% decrease in dividend income for the shareholders holding on to CVGW. The next one is a more popular company in the capital management space. It's NLY. They cut their dividend 26.14%. Moving from a 88 cents per share dividend down to a 65 cents per share dividend. Next, LU cut their dividend 70.59%, 17 cents per share down to 5 cents per share. Next, LOAN, Manhattan Bridge Capital. They cut their dividend 10+%. PSO cut their dividend 77%. EC cut their dividend 50%. And as we continue to move through this list, we can see that some of these companies are in better positions than others. Some of the companies are just making a small decrease, a small cut, and some of them are making a dramatic 90% cut, like Hersha Hospitality Trust, moving their dividend from 55 cents a share down to 5 cents a share. This is what could completely tank a dividend stock portfolio, especially for retirees that rely on the dividend income to pay their bills. This is why you have to try your best to find stocks that are in financial situations and have a track record of never cutting their dividends. Continuing on to scroll through the list here, you can see that just in March alone, a good amount of different stocks and funds have been cutting their dividends, unfortunately. This is not the situation that you see during a bull market. You do not see these types of dividend cuts when everything is going very well. But when things start to hit the fan, you see all different kinds of funds, stocks, and everything else in between shuttering up and waiting and hoping to make it through the storm. There might be more and more companies that are preparing for potential hard times in the future, so be sure to look through your dividend stock portfolio and realize that not every single stock and ETF are created equal. If you enjoyed this video and you want to see more videos like this, make sure to please drop a like in the video and subscribe for more. Thanks as always, and I'll see you in the next one.